Everyone to Stock Wisdom Tips. Today we'll be looking at, a couple of things, always looking at educating folks with our videos, and of course, looking at one or two names of stock positions or stock tips that we want to provide to our viewers. But before we jump in, help us support this channel. Please click that subscribe button and like button so that we can continue producing videos like this and continue educating and continue providing tips to all of you. So we're convinced that all investors should have in their universe of stocks a few names that they very closely watch day in, day out. So obviously these could be position names of companies that you have, within your portfolio. They could be names that you're looking to start a position in, or really for any other reason. So what we'll do is take a few minutes to look at what the stock summary is all about, what the different, fields are, what they represent, and why they're important. So, looking at Google here, also known as Alphabet, this screenshot was taken a few days back. Google's actually trading quite lower right now at $83.50, and we'll see in a couple of slides that that's really the one of the subject matters we'll be addressing today, Google stock. But let's take a quick look at this summary snapshot. Okay, on the left side we see previous close. So that's obviously the what price the stock closed the previous day. The open, what price it opened at, and as stocks today really are traded almost 24 hours. Um, so they're traded after hours as well, but there's always an opening at 9:30 a.m. Eastern time. There's always an opening price that is shown within this summary page. Now, the bid and the ask, these are interesting fields. The bid price represents the highest price that a buyer is willing to pay for the stock. Okay. And then the ask price is the lowest price that a seller will accept. And so the difference between these two is actually called something called the spread. And the higher the spread, the lower the liquidity of the stock. And a trade will occur when someone or something, because there's bots and computers right now that do a lot of these transactions. So when someone is willing to sell the security at the bid price or buy it at the ask price. Day range, this is something I look at very, very closely. So the lows and the highs intraday in very, very volatile markets like the one we have today, you can have a big spread within your day range. And it's not unusual, again, very volatile days. Like for instance, when the Fed makes an announcement on interest rates. Usually there's huge fluctuations within minutes that happen. And actually, a lot of people have made, and there's great opportunities to make daily gains, upwards of 5, 6, 7, almost up to 10% at times on very, very volatile days. So watch that days range. And then the 52-week range, everyone knows this is the high and the low within the last year. And then there's volume and average volume before we head to the right-hand column. So the volume typically, how many shares traded that day for that stock. And you always want to look at that compared to the average volume, because if something, if it was a light day or trading was light in that name, there's certain conclusions you can draw from that. But if volume was very, very much higher than average volume, which typically happens when there's key news that's being released or when earnings of the companies are being released as well. Looking at the right-hand side, continuing this conversation around market cap, that's the total value of the organization of the company taken by multiplying the stock price by all the outstanding shares out in the market. The beta value, this is a measure that shows how volatile a stock is compared to the market. So if it's a number above 1, we see here 1.1, it's more volatile than the market, i.e., it moves um, with much greater magnitude than the movements in the market. And if it's below 1, then it moves in lesser magnitude, lesser volatility than the market. So interesting, so if you look at a stock like Peloton, for instance, it has a much higher beta than Google does. And a stock like, a really, really boring blue chip stock like, I don't know, IBM, for instance, or Caterpillar will probably have a beta below 1. The price to earning ratio, PE ratio, by the way, TTM stands for trailing 12 months, so the preceding 12 months. And the PE ratio is the price divided by the earnings for said price. And this is a key measure for valuation, a metric that measures how expensive a stock is. The lower the PE, the cheaper it is, if you will. We talked about Ford and GM last week. The higher the PE, it's selling at greater multiples of earnings. EPS, earnings per share, 5.32 for Google. Earnings date, Yahoo really helps here by telling you earnings dates. And again, within the universe of the stocks, the 4 or 5 stocks you're following, you should always have a good visibility on when they're announcing earnings. And then forward dividend, Google doesn't pay a dividend, but if it did, you'd see both the dividend and the yield here. And then ex-dividend, if a company does pay a dividend, that's the date for which typically these companies pay quarterly or 4 times a year. The ex-dividend will represent the date at which the date of record for which you were an owner of the stock for which you'll get a dividend. So for instance, if it's November 5th, if you're an owner on November 5th, you'll get the dividend. If you were not an owner on November 5th, you will not. So people sometimes, buy securities based on those dividend dates. Not the best of strategies because the stock will trade down when it issues the dividend. But again, some different strategies people employ. Okay, we wouldn't be providing our viewers, with value if we didn't have a tip. So we had Google up there for a reason. We think Google is a must core technology long-term holding. So it's one of those buy it, put it in a drawer, don't look at it for years. Okay. Google has products that we rely on day in, day out, whether it be search, Gmail, and the countless other products. Those products aren't going away anytime soon, nor our dependency on them. Suffice it to say, Google is a cash cow, a financial juggernaut. The Q3 earnings were released recently. Their Google search ad revenue was $41 billion. So from a search perspective, that's a very solid moat. That's not going away anytime soon. YouTube, another crown jewel in their portfolio, 7.5 billion in revenue in Q3. It's incredible. They bought that business. I think it was for $1 billion some, 20 years ago, and they've grown it considerably. So again, we think this is a key holding. It's selling at pretty attractive prices right now. We think it's gonna still keep going down with this volatile market, but watch those key dates that we've talked about in previous videos. Right, the COVID low, $50.70. The December 2018 low, $48.50. We're not alluding that it's going to get there because the business has grown considerably since, March 2020, December 2018. But right now it's trading at $83.50 at a market cap of just over $1 trillion. So it's getting to very, very attractive levels. And again, the growth is there. Ad revenue is going to suffer a little bit during this downturn, but it will come right back up as soon as the economy shows strength again. Again, we're not professional investment advisors. We're just folks, very, very interested with these topics, very knowledgeable of these topics. But keep in mind that, investing in the stock market is a risky thing. Do your research, consult professionals if you have to. Um, great presenting this video to all of you. And once again, hope to speak to you soon. Wishing you financial health.